Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, Currency Analyst at MUFG. It's Thursday, 14th April 2022, and joining Lee to pose some questions on the financial market themes for the week ahead is Michael Owen, MUFG's Head of Global Client Desk for EMEA in London. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Good afternoon, Lee.
Hi, Michael.
The US dollar has hit fresh highs this week. Do you expect the bullish trend to continue?
Yeah, that's right, Michael. Certainly, dollar has regained upward momentum in recent weeks. And as we saw the dollar index back above the 100 level now for the first time since the kind of early stages of the COVID crisis back in early 2020. Dollar yen in particular has obviously captured market attention, with that also rising to its highest, well, through the high from back in June 2015, which was at 125.86. So clearly the dollar is kind of outperforming right now in the FX market. There are a number of kind of key reasons why we think that's the case. And obviously one of the main reasons is the kind of hawkish repricing that we're seeing taking place of Fed rate hike expectations. Obviously last week, that kind of hawkish repricing was reinforced further by the Fed outlining their plans for a more rapid pace of balance sheet shrinkage going forward. So it's a kind of combination of faster rate hikes and also shrinking their balance sheet going forward. That's certainly contributing to this period of dollar strength that we're seeing right now. At the same time as well, we'd also kind of highlight that it's not just the positive story for the US side of things, which is helping the dollar to outperform, but also we would also say that risks to growth outside of the US are also increasing, which is making the dollar look more relatively attractive as well. So on that side of things, it certainly looks like the kind of downside risks to growth in Europe are increasing from the conflict in the Ukraine. There were obviously initial hopes that we could see some form of peace talks, which could lead to a diplomatic breakthrough and bring an end to the conflict at a sooner date. But at the moment, it looks like those kind of peace talks have reached a kind of dead end for now. And it's looking more and more like this conflict is going to be prolonged and have more of a disruptive impact on supply chains and the global economy and European economy in particular going forward. Secondly, obviously, Europe's economy as well still faces the risk of a potential negative shock as well from the outcome from the French elections. Obviously, we saw last weekend the results from the first round, and that did show just a narrow victory for President Macron over Le Pen. And that still leaves market participants nervous that when we get to the second round at the end of this month, it certainly looks like the outcome is going to be a lot closer than people would like to see, and leaves us uncomfortable over the risk of an outside victory for Le Pen. So I think while that risk is kind of still lurking in the background, that as well is helping to boost the dollar's appeal. And I think finally the other kind of negative story for growth outside of the US, which is helping to support the dollar, is it's obviously what's going on in China. The spread of Omicron there is leading to fresh waves of COVID disruption in China, and certainly increasing downside risks to growth at the start of this year for China's economy, but also obviously the global economy as well, as obviously the supply chain disruptions that we've seen during COVID are likely to remain in place for longer going forward. So I think when you take all of these things into consideration, it makes sense that the dollar is outperforming right now. We would, though, be a little bit more kind of cautious about continuing to chase the dollar higher from here. We've obviously reached more kind of overvalued levels, and we'd also highlight as well that I think the US rate market is also well priced now for future Fed tightening. If you look at the rate market, 50 basis points is fully priced in for the next meeting in May, and then another 50 basis points in June. And by the end of the year, the market's looking for the policy rate to get up to 2.5%. So to us, that looks reasonably priced. So I think going forward, it's going to be more challenging, I think, for yields in the US to continue to kind of march higher that we've seen over the past month or so. So that could help to at least dampen some of the dollar upward momentum going forward, and we could be kind of entering into a period where the dollar starts to at least stabilize at stronger levels from here.
Yeah, thanks very much, Lee. And over the past week with central banks, what is your take on these?
Yeah, well, we've certainly had some different views from central banks presented over the past week. Obviously, the two kind of most similar policy reactions were from the Bank of Canada and RBNZ. Both of those central banks delivered larger 50 basis point rate hikes this week, clearly signaling more concern going forward that upside risks to inflation becoming more persistent. And obviously, they felt that if they didn't act more forcefully in the near term, that those inflation risks would be more prolonged going forward as well. So that's certainly the message that we got from them central banks, that they were certainly a lot more hawkish. On top of that as well, we also heard from the Bank of Canada that they're also looking to kind of reinforce their shift to tighter policy going forward by complementing rate hikes with plans to start shrinking their balance sheet as well from the end of this month. That's obviously another way that the Central Bank of Canada can tighten policy and put upward pressure on yields further out the curve. We would say, though, similar to kind of Fed pricing, that the market, interest rate markets in Canada and New Zealand, we think are already pricing in a lot of the rate hikes to come from the Bank of Canada and RBNZ. We think those markets look well priced now at this point. If you look at the Canadian rate market, the market was already expecting a 50 basis point hike this week, which was delivered, and is looking for at least another 50 basis point hike at one of the upcoming meetings, with the policy rate then expected to get up to around 2.5%, which the Bank of Canada has kind of signaled that would be kind of consistent with getting policy back towards kind of more neutral policy settings. Similarly as well in New Zealand, obviously we had the 50 basis point hike that was well priced, and we do think that we could get at least one more 50 basis point hike from the RBNZ, and then I think the market is looking for rates to get up to around 3% in New Zealand by the end of this year. So I think when you look at the market pricing, the fact that a lot of rate hikes are already priced in, that does, I think, help explain partly why, if you look at the performance of the New Zealand dollar and the Canadian dollar this week, they really kind of didn't really strengthen significantly on the back of these larger rate hikes. If anything, actually, the New Zealand dollar sold off quite sharply once the rate hike had been delivered. We think that could reflect in part some expectations amongst market participants that if central banks are kind of more active in terms of tightening policy in the near term and do more now, that could mean obviously in the future that they may need to do less, and that means that the kind of terminal kind of peak for this policy tightening cycle may be less than the market had initially feared. So we did see kind of yields further out the curve drop this week in Canada and in New Zealand, and that could partly explain why we're seeing some softness in the New Zealand dollar this week. And then finally today, obviously, we've also had the ECB's latest policy meeting. They kind of booked the trend. Obviously, like I said, the Bank of Canada and the RBNZ, they were on the more hawkish side, delivering larger rate hikes. Whereas today, the ECB message was one of kind of steady as she goes, really. They still kind of maintained the same forward guidance pretty much to what they had at their last policy meeting. They're still sticking to their view that they think QE is likely to end in Q3, and then shortly after, they'll look to start raising rates. So to us, that still suggests that the kind of earliest possible timing of an ECB rate hike is likely to be by September. That's on the assumption that QE ends in July, and then they follow that up with a hike in September. From a kind of market perspective, that certainly created some kind of initial disappointment. If you look at the European rate market ahead of today's ECB meeting, the market had been pricing in a high probability of a rate hike as soon as the July meeting. And obviously that looks not completely impossible now, but certainly less likely. Like it would probably require the ECB to end QE in July and also raise rates at the same policy meeting. And at this stage, the ECB is still saying that they want to do it in a kind of step-by-step process. So they want to end QE first and then follow that up with a rate hike. So it does make sense that the market has responded and kind of pushed back the timing of the first hike from the ECB back to September. And we've seen that kind of feed through very clearly into the FX market. Obviously, it's ahead of today's ECB meeting. Euro-dollar is trading back above 109, and it has dropped quite sharply after today's meeting, back down towards the kind of 108 level. And we do think in the week ahead that the euro is probably likely to remain on a softer footing. The fact that the ECB still seems to be kind of lagging behind other central banks in terms of tightening policy, even though we've seen very elevated inflation readings in Europe, to us is a negative combination, at least for now, for the euro. And the risk is that euro weakness could accelerate further if we did break below that 108 level where there's kind of key support.
Thanks very much, Lee, and wishing everyone a good week ahead.
Thanks, Michael.
Thank you for listening to this MUFG Global Markets podcast. Rate, review and subscribe, and reach out to your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research Team.